Today, let's continue to talk about Bitcoin, especially a topic that has recently confused many investors, Bitcoin's recent price trend. On the one hand, we see that Wall Street giants such as BlackRock and major companies are buying billions of dollars worth of Bitcoin every week in the news. On the other hand, the price of Bitcoin has been trading sideways for months after breaking through the $100,000 mark, and has been unable to set a new high. In any normal market, when demand is so strong and supply is limited, prices should soar. But Bitcoin is like a tethered beast, standing still. What is going on behind this? Is the market failing, or is a deeper change brewing under the calm water? In my opinion, to understand this phenomenon, we must first accept a key identity transformation that Bitcoin is undergoing. It is transforming from a high-risk speculative product to a macro-strategic asset similar to gold that is recognized by the global capital market. In this long process of crowned as digital gold, its price fluctuations hide an invisible and huge transfer of ownership. Today, we will play detective and reveal the reasons behind the stagflation of Bitcoin prices from clues, and explore its future direction. In our previous discussion, we have come to a conclusion: the ultimate storyline of Bitcoin is to become the digital gold of our time. This conclusion is the first principle for understanding all current market behaviors. Let's use a metaphor to unfold this story. Imagine that Bitcoin is like a rocket flying from the Earth to the Moon. Its destination, the Moon, that is, to reach or exceed the market value of gold, currently about $23 trillion, and become the world's preferred, non-sovereign value storage tool. Michael Saylor, founder of MicroStrategy, even gave a more amazing prediction. He believes that the price of Bitcoin may soar by 20,000% in the next 21 years, because he firmly believes that Bitcoin is superior to gold in almost all aspects and is the ultimate value storage network. Let's do a simple calculation. Assuming that Bitcoin replaces the position of gold, how much is it worth in the current situation? We divide $23 trillion by 21 million coins, and the result is that each Bitcoin is worth about $1.1 million. We conduct a static deduction on this issue from a single perspective. If we want to achieve the 20,000% increase mentioned by Michael Saylor, then the fiat currency will have to depreciate more than 100 times relative to gold, which seems a bit exaggerated, but he did not say when this increase would be achieved, so this judgment is not very meaningful. Having said that, before the Bitcoin rocket reaches the Moon, its flight will never be a smooth straight line. It will experience violent acceleration, shaking, leaving the booster, and entering different orbits. Every shake and consolidation is preparing for the next stage of acceleration. The same is true for the price of Bitcoin. Before it is truly fully accepted by the global capital market and its value consensus is as indestructible as gold, its price will inevitably experience huge fluctuations. But as long as its core narrative as digital gold is not falsified, its long-term value will not change. As time goes by, the more people believe in it and the stronger the institutions that hold it, the more cohesive its value consensus will be, and its price volatility will gradually decrease, and eventually, like gold, it will become a stabilizer for the macro economy. Therefore, the stagflation we are seeing now is not the exhaustion of rocket fuel, but more like a critical refueling and system self-check before it enters the next orbit. We can use another more appropriate metaphor to understand the current situation. Imagine the tradable Bitcoin market as a huge reservoir. Recently, an unprecedented giant water inlet pipe was connected, that is, the spot Bitcoin ETF led by BlackRock. According to CoinDesk, these ETFs have recorded a net inflow of up to $3.9 billion in the past few weeks alone. Billions of dollars of funds from institutions and companies are pouring into the reservoir through this pipeline like a tide. Logically, the water level of the reservoir, that is, the price of Bitcoin, should rise rapidly. But what we observe is that the water level has hardly changed. According to CoinDesk data, Bitcoin rose only 2% in June, the weakest monthly performance since July last year. This can only mean one thing: at the other end of the reservoir, there are several equally thick and imperceptible water outlet pipes that are quietly releasing water at almost the same rate. According to the information we have, there are three main outlet pipes. The first is some investors who have taken profits. This is the easiest to understand and the most market-compliant selling pressure. An analysis article by CoinDesk quoted the view of analyst Checkmate, pointing out that the so-called intentional price suppression by some behind-the-scenes forces is actually a false proposition. The real situation is the persistent selling pressure from long-term holders. Let's put ourselves in their shoes. If you bought Bitcoin at $10,000 in 2017, or even at a few $100s in 2015, when the price is stable at more than $100,000 today, it means that you have received a return of 10 times or even hundreds of times. Faced with such a huge profit that changes your life and the price is hovering at a high level, it is a normal human choice to choose to sell part of it to improve your life and lock in the profit. Glassnode's on-chain data also confirms this. The report pointed out that in this cycle, the realized profits have reached $650 billion, exceeding the $550 billion in the previous cycle. This shows that a large number of early investors are converting their paper profits into real cash. So, when ETF buyers excitedly rushed into the market, the first sellers they encountered were these long-dormant veterans. This is a natural turnover between new capital and old capital. For every new institutional buyer, there is one or more early holders who are cashing in the fruits of victory. CoinDesk's report cited a key indicator called accumulation trend score from Glassnode, which revealed a more detailed picture for us. This indicator tracks the behavior of wallet addresses of different sizes. The data shows Bitcoin whales, holding more than 10,000 BTC, they tend to distribute their holdings slightly and orderly. And some small holders are also net sellers. This shows that the selling is not from a single group, but a widespread phenomenon. The whales are likely to sell their bitcoins directly to ETF issuers through over-the-counter transactions to avoid impacting the open market price. A large number of small holders may lose patience due to the sideways market, or simply choose to leave the market to satisfy their existing profits. Another report from Cointelegraph adds two other important sources of selling pressure. On the one hand, miners are selling. Bitcoin experienced its fourth halving in April this year, which means that the reward for miners to mine new blocks has been halved. For miners with higher operating costs, they have to sell part of their previously hoarded bitcoins to pay for electricity and operating expenses. This is a regular, months-long selling phase after each halving. On the other hand, the U.S. government is selling. The U.S. government is one of the largest holders of Bitcoin, and its holdings of Bitcoin mainly come from the seizure of some dark net markets. The report pointed out that the U.S. government is selling these Bitcoins regularly. Although these sales are planned and conducted over the counter, each time they inject hundreds of millions of dollars of additional supply into the market. To sum up the current situation, the huge buying of ETFs is offset by the strong and continuous selling from long-term holders, whales, retail investors, miners and governments. The market has entered a delicate state of dynamic balance. It looks calm on the surface, but there are undercurrents under the water. Since there is huge selling pressure, is it possible for the price of Bitcoin to plummet again? I think the possibility of a crash in the short term is relatively low. The reason is that the dam of the reservoir is stronger than ever before. Unlike the last bull market, the main buyers entering the market now are no longer retail speculators seeking short-term profits, but institutional investors represented by BlackRock and Fidelity. They are making long-term asset allocations for their clients, and the bitcoins they buy will be stored, cold Bitcoin, locked for a long time, and will not be sold easily. This is equivalent to transferring the ownership of Bitcoin from the early holders whose beliefs are relatively fragile to the institutions whose beliefs are extremely firm. In addition, the supply and demand relationship has undergone a fundamental reversal. As mentioned earlier, institutional demand is extremely strong, while the bitcoins available for circulation in the market, i.e., liquidity, are becoming less and less due to the hoarding of whales and the absorption of ETFs. This severe supply-demand imbalance provides a solid bottom for prices. Of course, risks remain. If there is a severe global macroeconomic recession, resulting in a sudden interruption of institutional capital inflows, or an unexpected black swan regulatory event, then prices may indeed experience a deep correction if the selling inertia remains. But this is more likely to be a healthy adjustment rather than a crash. Glassnode's report also pointed out that profit-taking activities have begun to slow down, indicating that the selling pressure may be coming to an end. Based on the above analysis, we can foretell a rough roadmap for the future trend of Bitcoin. Short term, next 3 to 6 months, consolidation and accumulation stage. The current sideways consolidation stage is likely to continue for a while. This will be a boring, but crucial period, and the market will continue to complete the transfer of ownership. The long and short sides will repeatedly seesaw above $100,000 until the profit-taking of early holders is fully digested. This process is like a final check and refueling of fuel and systems before launching a rocket. Medium term, next 6 to 18 months, supply shock and real breakthrough will appear. This is the most anticipated phase. When the selling pressure from early holders gradually fades and the buying demand from ETFs remains strong, the real supply shock will come. At that time, there will be a situation of one coin is hard to find in the market, and even relatively mild buying may cause a disproportionate and sharp rise in prices. This is what analysts call a real breakthrough. Once the breakthrough occurs, the price will enter a new and potentially too high to touch phase. Long term, next 3 to 5 years and beyond the official coronation of digital gold. Bitcoin will gradually complete its identity transformation, and its value will no longer be linked to altcoins or short-term market sentiment, but directly benchmarked against the total market value of gold, currently about $23 trillion. As its volatility further decreases, it will become an indispensable strategic reserve asset for hedging fiat currency risks in the portfolios of central banks, sovereign wealth funds and large institutions around the world. Its current market value of about $2.13 trillion still has huge room for growth compared to gold. Back to our original question, why is the price of Bitcoin stagnant? The answer is now very clear. I think this is not stagnation, but a carefully executed, epic, change of dealers. This is a process of transferring hundreds of billions of dollars of assets from the hands of decentralized, anonymous early believers to the centralized, transparent balance sheets of Wall Street giants. The reason why this process seems calm is that the main part of the trading takes place in the backroom OTC market, out of the public eye, and is tacitly controlled by the new dealers for their own long-term interests. Therefore, for ordinary investors, the most important question to ask now is no longer, why doesn't it rise, but, which side should I stand on in this great change? The current sideways trading is like a spring that has been compressed to the limit. Everyone knows that it will eventually bounce back, but they are not sure about the time and strength. Smart investors will not lose patience because the spring is temporarily immobile. Instead, they will use this precious time to assess risks and adjust their positions. Because they know that when this controlled ignition ends and the real flames rise, it may be too late to get on the train. The above is some information and personal opinions I shared with you today. Thank you for your company.